And many of their smaller competitors have all raised interest rates in the past week in step with each other, but out of step with the Reserve Bank. It comes as the head of Australia's corporate watchdog and many analysts warn that Sydney and Melbourne are experiencing a property bubble. But even though the rate hikes are across the board, the pain for borrowers won't be shared equally. Investors will experience the biggest rises as banks seemingly heed the warning of regulators to cool the heated property market. Here's Carrington Clark.
The official cash rate set by the Reserve Bank still sitting at the historical low of 1.5%, but still loan repayments are going up.
The commercial banks, even though the cash rate hasn't moved, are repricing their loan products because their funding costs are now higher.
Stephen Walters, chief economist at the Australian Institute of Company Directors, links it to one major event.
So just before the US presidential election, bond yields in the US were below 2%. This is 10-year bond yields. They're now up around 2.5%. So that's about 80 basis points higher than they were just 4 or 5 months ago.
But others think it's about banks being politically clever.
The reality is it's been hard to raise rates, especially out of cycle with the RBA. And the politicians are always on the back of the banks, basically, and every time they lift rates, they're very quick to jump on the banks. The banks have basically worked out that investor loans, you can actually reprice them up rather than owner-occupied. No one really says anything. The politicians let you get away with it.
After 2012, the issuing of new home loans took off. The regulators stepped in at the end of 2014 to cool the market, and for a time it worked. But it's back rising at a strong clip, driven almost entirely by investors.
There's no doubt that the actions did address some of the risks. Nevertheless, the early experience suggests that, while the resilience of both borrowers and lenders have no doubt improved, the initial effects on credit and some of the other indicators we use to assess risk may fade over time. We are continuing to monitor their ongoing effects and are prepared to do more if needed.
The RBA has made clear to the banks that skyrocketing house prices in Australia's 2 biggest cities are creating a financial stability risk to the economy.
I think the banks are certainly having conversations with the regulators about perhaps targeting these rate hikes to areas where perhaps the risks are getting a little bit beyond what the regulators are comfortable with, and that's particularly the non-owner-occupier investor segment of the market.
Investors are being hit hardest, but so too are owner-occupiers with interest-only loans, who might be particularly vulnerable.
If you're only paying off the interest and not paying off your principal, it does suggest that perhaps you've got a loan that may be stretching your affordability a little bit.
In the last few years, APRA and ASIC have basically asked the banks to tighten up their lending standards, which they've done. And so the problem is you've got people who have taken interest-only loans, say 4 or 5 years ago, which start to roll in the next couple of years, which will switch into principal and interest payments, and potentially they can't afford those payments.
And there could be more pain to come.
People need to brace themselves for, even though the Reserve Bank won't be doing anything on interest rates in terms of rate hikes, that there's probably more increases in mortgage rates coming through.
The RBA will be hoping those increases cool the property market and not just boost bank profits.